Yeah, people are coming in, so I'm going to get started. Welcome to the EACC's Autumn EU Economic Update, Converging on a Soft Landing. This event is organized by the European American Chamber of Commerce in New York, and my name is Yvonne Bendinger-Rothschild. I'm the Executive Director of the EACC-NY, and I will be your host and moderator for today's event. My conversation partners include Ben Carlina, he's the senior economist at the EU delegation to the US, and Maddalena Peretti, an advisor at the ECB's permanent representation to the United States. And we're here today to discuss the European Commission's Autumn 23 economic forecast that was released earlier this week. I believe it was Wednesday. And the following robust post-pandemic expansion, both in 21 and 22, the EU economy has lost a little bit of momentum. Real GDP contracted mildly in the fourth quarter of 22, and the high cost of living took a heavier toll than we were expecting. External global trade factors have also not rebound to a degree that we would have liked, which is also dampening the economic developments. But we're still dealing with high inflation. It's working its way through the economy. I'm personally, and that's just my personal non-economist opinion, think that we should be getting inflation under control, but our panelists will get further into that. On the other side of the pond, the US economy has grown faster than the European Union's. And we will discuss in greater detail what some of the differences are between those two trend lines. Ben, can I start with you? Do you want to offer some background on where we are and maybe also what the discrepancies between the EU and the US growth numbers are?
Sure, absolutely. And thanks once again for having me, Yvonne. It's great to be back. Maybe I can just begin with some of the key messages from the forecast and set the stage a little bit. I think the main takeaway in terms of this year of 2023 is that Russia's invasion of Ukraine has had a major impact on the EU. The post-pandemic momentum that we built up with all the reopening and people going out, traveling and shopping again, most of this momentum was lost, though the EU did manage to avoid a recession. Growth hasn't been great this year. GDP barely grew for the first 3 quarters. And the key headwinds really were, of course, energy prices, this big energy price shock that we had following the invasion, and weak external demand, as you mentioned in the intro. There have been, challenging economic conditions in China, for example. We can talk more about that later, but demand for European exports has not been as strong as people were hoping. And then, of course, we also have tighter financial conditions because in both the US and Europe, we saw this, tightening from monetary policy, and higher interest rates have been slowly feeding through into the economy, raising borrowing costs. So maybe we can get the slide deck up and go to maybe the third slide, just to go into a little more detail about the growth outlook. In broad terms, you mentioned the numbers for this year already, but for 2024, things are set to pick up. So one of the contrasts that you mentioned is 2023 in the United States has been this period of economic outperformance. The Q3 numbers in the US were really exceptional, remarkable, I would say, and a testament to the strength of household spending in particular, where consumers have really been driving all of the growth, most of the growth in the United States, on the back of some of the excess savings that they built up over the pandemic, but also the wealth effects from high real estate values and from a pretty good stock market performance over the past couple of years. So US consumers have been feeling really positive, and it's much less true in Europe. Maybe we could go to the slide before this, the one that has the map on it. So broadly speaking, for the euro area, the Commission is forecasting growth of 1.2% in 24, stepping up a bit to 1.6% in 25. And it's basically the same for the EU as a whole. It's 1.3 and 1.7, so just a tenth higher. And for the United States, the Commission is forecasting 1.8% in 25. Sorry, 1.8 in 25 and 1.4 in 24. So it's similar. It's basically the situation is this period of economic outperformance in the United States is set to slow because there's some headwinds in the U.S. There, people have to pay their student loan payments again, and higher rates from the Fed are going to start to bite a little bit. Whereas in Europe, things are set to improve a little bit. So you'll have a bit of a slowdown in the U.S. and a bit of a recovery in Europe. And maybe to talk a little bit in more detail about some of the specific countries, you can see by this map that partly what's going on is that the countries that were most exposed to Russian energy and also to manufacturing exports have had the weakest growth. So Germany, for example, which is really the heart of many European manufacturing sectors, the German economy is actually expected to contract this year by 0.3%. And, in particular, energy-intensive manufacturing is having a tough time, and the fact that external demand has been relatively weak has not helped. But even in Germany, while we're not getting quite as much as a pickup as we would hoped, in 24, we hope to get 0.8% growth, and slightly better in 25, 1.2%. France has been doing a little bit better. France, as you know, relies a lot more on nuclear energy for its electricity. And so growth is expected to be about 1% this year and increase by about 0.2 to 1.2 and 1.4 throughout the forecast horizon. Italy,
Ben, can I ask you a quick question just out of curiosity, and it occurred to me just a minute ago. So France relying more on nuclear energy, does that influence both corporate spending as well as private spending, consumer spending, I should say?
Well, I mean, I think the way to think about it is the ultimate end cost to consumers and businesses. And it's a little bit, one of the things that's a little bit tricky about this is that many member state governments have been providing energy subsidies to cushion the cost of the energy price shock. Now, this has been more expensive in countries that have been having to deal with that were more exposed to Russian energy than others, but some of that cost has been absorbed in fiscal policy by the national authorities. But another way to think about it is in terms of the overall competitiveness of EU exports versus the US, for example, because in the US, natural gas prices, I think, are a third or maybe even a quarter of the price in Europe. And electricity prices, I think, aren't quite as cheap, but they're something like 3/4 to a half of what they are in many European countries. So this matters much more, in terms of businesses, although some businesses in Europe have been receiving subsidies, but it helps. That's a further reason why the weakness in foreign demand has been exacerbated by this terms of trade challenge that has made EU goods a little bit more expensive, or at least the cost of it has been distributed either directly to the companies or to some extent in fiscal. So that's part of it. But also when you're looking at countries like France and Spain and Italy, they have much bigger tourist sectors than, say, Germany does. And that has been, on the one hand, part of the relative strength that these countries have had this year. France and Italy and Spain are not in recession. And so, the different makeups of the different member state economies also matters. So just to say, Italy and Spain both have benefited from this and are not forecast to have recession. I also wanted to mention really quickly Ukraine. because Ukraine is now a candidate country to eventually join the EU. And so this was the first time that the EU included Ukraine in its forecast. And just to give you a quick sense of what the Ukrainian economy has done, when in 22, following the invasion, GDP collapsed by almost 30% in Ukraine. And the economy came close to falling apart, right? The authorities were having trouble collecting taxes. A lot of the industrial base, which was in the Donbass, was lost. But in 23, growth is set to pick up, and the commission forecasts that it's going to hit 4.8%. On the one hand, there's been a good wheat harvest, which potentially bodes well for global wheat prices. But there's also been, a lot of government spending, and some of that is because the government has started collecting taxes again, but also just to say the unwavering support of European and American support, macro financial assistance included, has gone a big way to helping this happen. So maybe I should stop talking about growth at this point, and Madalena can jump in and talk about the inflation outlook.
Yeah, thank you, Madalena. Inflation.
Sure.
What's the ECB going to do?
So, good afternoon, everybody. Perhaps we can also show, we should have a slide on the inflation picture, which will tell you about the EU. I will focus mostly on the euro area dynamics. So we have the latest data is really good news. So inflation is down to 2.9% in October, and inflation excluding energy and food is at 4.2%. So what does this tell us? Basically, the disinflationary process is continuing quite strongly. We do need to be a little bit cautious with this very good last round of data, because of course it is influenced by very significant base effects. So half of these positive readings probably come from a decline in energy inflation, which went down by 11.1% more or less, and a smaller but still very helpful decline in food inflation. So this is really good news. We may see, because of the fading out of the space effect, a little bit of an uptick in inflation in future readings. That does not necessarily mean that the disinflationary process overall will have stopped, but we are comparing year on year, and we had a very significant energy shock last year. The ECB also sees inflation returning to target 2% around 2025, and new data is incoming. What we see that is interesting also is that dispersion amongst various components of inflation is narrowing. So this is a bit you see in this inflation breakdown chart. Wage growth is increasing, but the good news is that we don't see any signs of sustained wage growth spirals, which is a bit the scarecrow for monetary policy experts. There's no evidence of that so far. Overall, peak seems to have passed, but we still have a way to go. Looking a bit at some important elements, the news on food inflation is indeed quite good. It's declining. The impact of the energy costs on food production going down. Now we might start dealing with slightly more complex issues, because labor costs will now play a larger role in food prices. And of course, these are a bit harder to work through. There are also a number of upside risks that are a bit beyond the influencing powers of central banks, because of course, if we see again a lack of progress on a grain deal between Russia and Ukraine, then this positive effect that Ben mentioned from the positive news of the wheat harvest in Ukraine will not really be felt. And then there's longer term phenomena as well that will influence food prices, climate change related ones especially. So you see that extreme weather events, which are most likely linked to climate change, are starting to impact food prices. For example, the heat waves in Europe this summer, or other very complex phenomena such as El Nino that apparently is continuing later into the year. Energy prices, I think Ben has given you a bit of the picture, so I will not go that much in depth. They're going down significantly. We still see some volatility in oil prices, and of course there's a lot of uncertainty surrounding them. Gas storage levels in Europe are very good. This is really good news. This does not mean that prices will not be sensitive to supply side shocks. So we could still see some movement there, but Europe is ready to face winter as far as gas storage goes. And I think Ben mentioned enough about wholesale electricity prices, which really have declined. One last
Can
word
I
on
jump
inflation.
in on the energy storage? And because I thought that's an interesting sub discussion. We managed to keep the energy storage or a refill at the storage fairly quickly, despite the energy shortages due to the war. How is that? What's the expectation? How is that going forward? Can we keep up that pace?
So it looks like we could keep enough storage to go through this winter and leaving even half storage levels until March 24. But this, of course, does rely on the assumption that we maintain this decline in energy demand, right? So this we have to assume that we can keep on doing what we did in 2023 to moderate demand. And I think this complicates a bit the picture because, of course, on the manufacturing side, this has long-term implications for especially certain energy-intensive industrial sectors. Then I was going to tell you a little bit about core inflation. So this is the measure of inflation that has been most persistent. So this has been the case both in the EU and in the US. It's not really a EU specific phenomena, but it will now possibly continue. And what we see is that it's now more likely going to be driven by goods inflation. So a disinflation in core will be driven by goods inflation, while services inflation might be more persistent. Now, this is a bit the case also in the US. It might be because services are more reliant on labor costs, so more influenced by labor costs, right? So as wages start rising, services might continue to see increased prices. An interesting, last interesting fact that I think I'll mention is, because this is also a phenomenon that differentiates the EU a little bit from the US, is that we should now start really looking at the details of how labor costs increase vis-a-vis profit margins. So we've seen this conversation on both sides of the pond. Profit margins did explain a large share of the domestic price surge in the euro area. Now, this can be both good and bad news as they go down, which is good news, they're going down, lower pressure on inflation. Potentially bad news is if they don't serve as a buffer for the rising labor costs, and then firms start passing on rising labor costs onto the end consumer. So this is a bit of dynamic that we need to keep an eye on. And what happened in the US is slightly different because I think unit profits went down faster in the US compared to the EU. Final word on the inflation outlook is that it is surrounded by significant uncertainty, but things seem to be going in the right direction. The long-term inflation expectations is something, of course, central bankers really care about, remain anchored around our target. So, cautious optimism.
Very good. Thank you for that. So let's dive into how did we get to where we are? We at the last conversation that we had during the summer, we concluded that both EU and US came out of COVID and much better than we expected. We also realized with the last economic forecast that the EU is dealing with a situation in Ukraine. Let's not call it a situation, with the war in Ukraine, much better than initially thought. Let's talk a little bit about the reforms. There are lots of structural reforms. What did we do? Is it working? And what's next? What's left to do?
Yeah, well, I think one of the key things is these pandemic era instruments that were created to provide support to the economy were adapted to deal with the energy price shock. And one of the key things about providing funding, the Recovery and Resolution Fund I'm speaking of, and also Repower EU, these programs They provide the combination of grants and loans to help countries boost investments in green technologies and come up with new energy infrastructure so countries can move away from importing Russian energy and import LNG from abroad, or install new solar wind capacity, things like that. But it comes with strings, and the strings tend to be structural reforms. And for many years, the European Commission would provide these analyses and studies of all the member state economies, and they would have this list of reform recommendations, but there was never a way to force countries to do this. And of course, structural reforms are politically challenging, right? It's hard for governments to build political coalitions that can get these things done. But if you offer the carrot of, here's a pot of money that you can use to invest in this good stuff, it helps things along. So one of the reasons why growth is set to pick up in the next couple of years is because there's going to be more and more money flowing from the RRF. Countries have to submit plans. They have to say, we're going to make these reforms. The money's released in tranches after the Commission reviews what they've done. And so far, a lot of these reforms appear to be working. So for example, Italy, they're making a lot of reforms to the legal system to allow companies to get through bankruptcy proceedings and things like that much quicker. Other countries are making reforms to their labor markets to make them more flexible. And we won't really be able to tell for many years how successful these things have been, because structural reforms take a long time. But they're aimed at boosting the long-term productivity of the European economy, and hopefully will work. I don't know if Madalena wants to jump in on any of this.
I mean, I can give an anecdotal comment from what we're working with. We have a program coming up on the EU Mobility Directive. I think that's going to be really interesting. It's going to make it easier to do business across the EU. So I encourage everybody to join us for that event. But
but it's also the case that the high profits that Madalena was talking about earlier, high corporate profits. One of the things that I should mention about all these public sector spending initiatives is that they're really trying to crowd in private investment for the most part. And the fact that corporates have pretty strong balance sheets helps, because a lot of it enables businesses to make investments alongside the public sector that can really help move things along. And I think that's one of the reasons why the forecast does call for a modest recovery, and that's a good thing.
Yeah, I totally agree with you, because what this does is it takes the risk out of the market. So you have good, well-fed corporate balance sheets. You add some public funding to it, the various initiatives, digitalization, investments in the green economy, and that creates an extra push and stability. Companies are not saying, oh, you know what, I'm not sure about the environment or the market environment, I'm holding back with my investments. They get an extra push from that public money that is, I don't want to say sloshing around, but that is now more available, although with more restrictions and feedback mechanisms. But speaking of risk, let's talk a little bit about geopolitical risk and the environment that we're in. We already covered the energy prices.
Well, just to say, I think that when we talk about geopolitical risk, to a large extent, what we're talking about, in economic terms at least, is the potential impact on energy prices. So in addition to the war in Ukraine, we now have this new conflict in the Middle East. For now, it appears that things are contained, but there is concern that if things were to spread and war was to spread elsewhere in the Middle East, that you could have some disruptions to energy supplies. So we hope that won't happen. And right now it looks like it won't. But in terms of discussing a key risk is that energy supplies are somehow disrupted and that causes another spike in prices. But for now, we don't see that. And it's also plausible that there's no disruptions at all and that energy prices come down. It's just, who knows?
Yeah, I share your optimism on this. I don't think it's going to. It just brought up this graph from the report. Do we want to
These
say
are the
anything?
assumptions used in the forecast, and they're based on forward futures market prices.
Good. So let's talk a little bit about global demand, or dive into more. EU, US, China. Who wants to take the first stab on that? Ben, you or Madalena?
I can start. So, we were talking earlier about the big terms of trade shock that the war in Ukraine caused for Europe. And essentially, it's very simple. It's that energy prices spiked. Europe had to spend more hard currency on importing energy, and that really hurt the trade and current account balances. Now, the decline in energy prices that we have seen since you can see these spikes from 2022. On the one hand, it's helped bring inflation down. It's also helped improve the terms of trade. So for the EU as a whole, the current account surplus is set to grow this year and should end 23 around 2.5% of GDP. And so that's evidence that the European economy is already adapting and this terms of trade shock is starting to wear off. But there is this broader issue of many European economies are very open economies and they export a lot. And it's important that the rest of the world is growing strongly so that there's demand for European exports. And there's been a lot of concern recently about what's going on in China. China is working through some issues in its real estate markets, but by all accounts, it's going to take them a while to do so. And it's going to be expensive because for all kinds of reasons, because they've built too many apartments and too much of, local government tax revenues are derived from real estate investments in China. So there's going to be this period of restructuring, and forecasts for Chinese growth have come down a lot. And there's a couple of ways to think about these spillovers and how it will affect Europe. On the one hand, China will import less, or even if they won't import less, the growth of European exports to China, the growth rate will decline if there's weak Chinese demand. But a slowing China also has effects on a lot of its trading partners, particularly in East Asia, because global supply chains are so spread out over the globe and integrated. So you could also see falling European exports to countries in East Asia and Southeast Asia and places like that. More of an outside risk that I don't think we're too worried about is financial contagion, because there are, development firms in China that have borrowed a lot of money and that have started defaulting. My understanding is that, these risks are relatively contained and it's not expected that there's going to be any financial contagion, but you never know. So it's something that people flag as a possible risk. But
I think and I don't know, Madalena, if you want to comment on that. That is actually my biggest concern. That you can keep on printing money, but at one point, the collapsing funds, private equity and otherwise, and maybe a couple of banks alongside in China, all around the real estate market, and loans crashing in. That is something that worries me a lot.
I would tend to agree with Ben in the sense that we don't really have, it's very difficult to quantify financial contagion of this sort, right? Because it's extremely complex. But what we do know at the start of the chain, let's say, is that a lot of these real estate firms have issued debt that they've placed on international markets in, let's say, non-negligible amounts, but they're not as intertwined with the international financial market as of yet. Still, of course, there are issues of lack of transparency, and so our understanding of exactly what is going on there may not be perfect. And just to complement what Ben was mentioning on China, I think an interesting thing to mention is that when we look at this, we also really have to look at a longer horizon. There are structural issues in the Chinese economy that may have an impact, of course, in European economies. So if you will find, if you read this forecast, that the Commission did do some simulation work, assuming a slowdown of the Chinese economy, they find that the overall impact would be contained from direct effects, though. So, as Ben was saying, in complex global economies, the indirect effects may be not negligible. But these structural factors will not go away. There is no immediate policy solution. So we really need to get into a mind frame of thinking of this as an ongoing challenge, potentially. And when I talk about structural factors, I'm just talking about, the Chinese economy being, in general, highly indebted. So not only the local governments that Ben mentioned, but also corporates, they just have higher levels of debt compared to other economies at similar development levels. So this is just diversion from what you would expect, and it's to specificities of the Chinese economies. Of course, like many Western economies, China has very adverse demographic trends it has to face, and a very weak social safety net. So you will continue to see in this, if there are no significant challenges for Chinese consumption to keep up, because people have structural incentives to save. So of course, if you're looking at it from the perspective of an exporting economy, this might be more challenging. I should also mention probably, though, that one aspect we haven't talked about is the negative inflation in China. Some people have worried about spillovers. The ECB did conduct some analysis on this and basically found that even though there might be significant spillovers for prices of imports, the inflation impact on euro area inflation would be limited. So even though this is mentioned as a concern, so far we don't see it as a big issue.
Yeah, the other thing I think to say is that the Chinese authorities do have the know-how and the resources to contain financial instability on a systemic level, right? Like, people are going to take some losses on some investments that they have made to Chinese real estate developers. But when financial markets are working properly, people take losses, and it's sad, but it doesn't cause systemic instability. And I do think that the Chinese authorities are aware of all these issues and are working to correct them. It will just take a little while, and growth is going to be a little bit more subdued. I should also say that it's not just China and East Asia that matter to the U.S., to Europe. The U.S. is also really important. And I just want to point out that hope of a soft landing has risen a lot in the United States recently, because the economic data have been so amazing. And that would be very good for Europe, right? The better that the U.S. economy does, the better the European economy is going to do next year. So the fact that consumers in the United States still have strong balance sheets, they're still spending. You've also had, similar to Europe, in the United States, the Inflation Reduction Act has been helping to boost investment in a lot of green technology areas, and particularly in the manufacturing sector. There's a lot of infrastructure spending that's still coming. So while the U.S. is definitely supposed to slow down, it's supposed to slow down below potential, because in the third quarter, growth was well above potential in the United States. And so that should help ease inflation in the United States further, and should also help, assuming that they can stick the soft landing, help European exports as well.
Yeah, and consumer spending is still really good in the United States, isn't it?
Yeah, absolutely. And I think, people have been wondering, like, what accounts for the discrepancy between spending in the US and Europe. And there's a couple of potential answers. On the one hand, US households um, might have received a little bit more in terms of like public sector support during the pandemic than in Europe, just in terms of the size of the money. So maybe US households had a little bit more excess savings. But there were excess savings on both sides of the Atlantic. And households on both sides of the Atlantic have also enjoyed pretty significant wealth effects from rising stock and real estate values over the years. And so the question is, why have American consumers been spending so much more than Europeans? And I think it ultimately comes down to sentiment, right? The war in Ukraine feels very far away from the United States, and it hasn't had a major impact in terms of how households feel and what their spending patterns are at all. And so the savings rate, which is a flow measure that measures, you take disposable income and subtract consumption, and what's ever left is the savings rate, has fallen a lot in the United States, but it has not fallen in Europe. And that's probably because people are feeling a little worried about what's going to happen with the war. How's this going to affect things? But conversely, this is one of the upside risks to the forecast, that people already think that consumption is going to expand in 24 and 25. And mostly because of the strength of the labor market, that the unemployment rates are very low at historical lows in Europe, and wage growth is going to start to pick up. But there's also this sentiment factor that maybe people won't feel much better depending on what happens in geopolitics, but maybe they will. And so that's something to watch, and is an upside risk to flag.
Interesting. Thank you for that. So what are we concerned? What are the concerns both in the EU and in the US? Just broadly.
Well, in the US, I think there are some concerns about the fiscal trajectory based on the sort of dysfunction in Congress that luckily Congress did just pass this continuing resolution that will avoid a government shutdown, but there's another risk of a government shutdown coming in late January. More broadly, there's going to be a lot of borrowing coming from the US Treasury, and it's unsure what effect that's going to have on interest rates. But in Europe, I think it's more likely that you see a slow but steady increase in household spending, in part because real incomes are set to grow more strongly next year, because inflation has come down so much, and because you're going to get these wage increases that through collective bargaining agreements that are stronger in Europe than in the United States. You're going to see real wage gains that will boost spending. Now, of course, the risk is whether this limits the ability of inflation to come down. So there's sort of risks on both sides here. But I think that at least the Commission thinks that a lot of the collective bargaining agreements are going to see one-time changes that bring wages up, but then wage pressure should start to ease from there.
Yeah, interesting. Long-term, short-term political risks, and if we can say just a few words about the friendshoring trend. I mean, we're seeing it here at the EACC. It's absolutely incredible. But in both directions, U.S. companies investing in Europe and Europeans investing here. How did that factor into the forecast?
Well, I mean, this is something, broadly speaking, that I would say Europe is a little worried about, because there are still some ongoing trade disputes with the United States that have not yet been resolved. People are still negotiating them and trying to come to solutions, between the Commission and the U.S. authorities. But in general, apart from the household spending, another reason why things are modestly looking up in Europe is because business investment is also supposed to pick up. And so it's a little bit difficult to disentangle how much of this investment is being promoted by things like the Inflation Reduction Act or the Recovery Fund in Europe, and how much of it is because companies are looking at rising geopolitical tensions and saying, I want to bring some of my supply chain back to my neighborhood. But both are likely contributing to some extent. And what's important, though, is that the business investment is supposed to turn up as opposed to continuing to stagnate or decline.
Interesting. Ukraine. Everybody on both sides of the pond is complaining how much money we're spending there. Can both of you or one of you put that into context a little bit? What are we spending? Can we afford it? And just comment on that.
I just one word on friendshoring before we move on to Ukraine, maybe, though. I think it's interesting, but a word of caution is that you may not see that trend in the data. So as you say, you hear from your members that this is indeed something that's happening, and the ECB also conducted a survey that showed firms are thinking both to bring either back production to the EU, to bring it to countries that are considered to be politically aligned. So this is the friendshoring. But these are longer term issues. So you may not see in the data yet. And an important thing to differentiate is what impact we will see on activity and what impact we will see on employment. So both of these are really important to keep in mind, and they may not move in the same direction. As it's not necessarily true that companies might choose to produce again in the EU. They might choose to produce in an economy that is more politically aligned, but not necessarily within the union. So back to on Ukraine, I mean, I can just put into context in terms of absolute numbers which are publicly available, and there the EU has really sustained Ukraine at significant levels. So there's a bit of this narrative that there is perhaps less support from the EU than the US. You might get that impression from the media. It's not really what actual spending reflects. So you've had about 86 billion, I think, already committed by the EU to Ukraine. This contains, humanitarian, military aid, but also pledges for future spending are really significant, coming from the EU and member states. And so far, they even outpace significantly pledges from the US. The Commission is planning a Ukraine facility dedicated to focusing on also longer term reconstruction and support of the Ukrainian economy. So overall, I think the numbers are quite significant, but completely in line with the economic power of a union such as the EU. Of course, the pledges are pledges. We need to wait to see if all of them go through, but it seems to be really significant for now.
Yeah, I just want to bring that on the table. Yeah.
Well, just in simple macroeconomic terms, the amounts of money that Europe and the United States has been providing to Ukraine, while it's crucial to the Ukrainian authorities, it's easily affordable for economies that are the size of the US and Europe, that have annual GDP over 20 trillion every year. It's not a problem at all. The problem, of course, always comes down to the politics of it. And one of the key concerns is whether the commitments that the U.S. administration has had to support Ukraine in 24, whether those commitments can be passed by the Congress, because there's increasing opposition on the right wing of the Republican Party to further macro financial aid in Ukraine. And the negotiations have been fraught, and we still don't know when or even if this latest batch of Ukraine aid is going to get approved by the Congress.
Yeah, that makes things obviously unnecessarily complex. Let's dive a little bit further into comparing or let's compare the US and EU performance. Because we already discussed that looking backwards, but when we look at what we're dealing with, how do we project that forward on both sides?
Well,
what are our expectations?
Not to put Madalena on the spot, but I think a lot of what will happen will depend on the path for monetary policy. Because in the we've had this big inflation shock. Inflation has now come down a lot, but it has not returned to target yet. It's not that close to target on either side of the Atlantic. And, central banks are in this tricky position because they have to, in the United States, it's more explicit that the Fed has both a price stability mandate and a full employment mandate, whereas it's just price stability in Europe. But nonetheless, nobody wants to cause a recession if they don't have to. And but the inflation numbers haven't come down enough to give central bankers confidence that inflation is sustainably and reliably on its way back to the 2% inflation targets. And so this is, I think, one of the key questions for the coming year is that how much of the decline in inflation that we've seen so far, is that the easy part? And how much, as Madalena was discussing earlier, is going to be slow work to get wage pressures to slowly ease and service sector inflation in particular to come down? That remains an unknown. The quicker it comes down, the quicker that central banks can pivot to cutting interest rates. But it hasn't happened yet. And I mean, markets don't expect cuts in the United States till mid-year 24. And I think futures prices for Europe are even later, right? It's end 24, early 25 for ECB cuts. Just the markets. I'm not talking about what the ECB is actually going to
do. Markets expectations, yes. I would say here that, to be honest, though, of course there are questions, and they're open questions, however, the commitment by the two central banks, and this is maybe where I stop to reiterate my usual disclaimer that I'm speaking my personal capacity, the path for the two central banks in their stated intentions is quite similar. Both Powell and President Lagarde have said that they remain committed. They said clearly the job is not done. Powell said explicitly a couple of months of positive news will not sway the Fed necessarily. They need to be convinced that inflation is going to target. And on the other hand, the ECB has also said that in the future they will continue ensuring that policy rates are at sufficiently restricted levels for as long as necessary to bring inflation down, right? And they similarly are taking data dependent, or as the Fed says, meeting by meetings approach. So there is not really a divergence in the approach by the two central banks. Of course, there are different questions. On the wage pressures, one should also note that it might be slower. It doesn't have to be negative labor market impact that you see. It's not. We're not expecting major disruptions. So sure, the last mile might be relatively hard, but I don't see a difference in commitment between the two, the Europeans and the Americans. So in that sense, they're pretty aligned, and market expectations are a bit diverging more for the US, but that's a bit more complex matter.
Yeah, certainly nobody should doubt the commitment of central bankers to achieve their targets. They have the tools, they know how to use them, and they are going to get inflation back down. I don't see any reason to worry about that. But there are these questions about how long and variable the lags are between raising interest rates and how long it takes higher borrowing costs to feed through into the economy. And I think in that case, there are differences between how the transmission policy works on both sides of the Atlantic. And, one of the questions in the United States in particular has been whether, the transmission for rising interest rates works a bit differently than cutting interest rates. And the key reason being so many American households have long-term fixed rate mortgages where they locked in very low rates previously. And so interest rate increases don't really affect them. And likewise, many corporates on both sides of the Atlantic went and locked in pretty low rates in their bond and bond offerings and bank loans and stuff. And so they haven't been affected by that much. But the longer that you keep interest rates high, and there's been a lot of discussion of higher for longer, eventually that's going to have an impact and is going to slow demand. And when exactly that happens has been a question mark. I think in the United States, people have been surprised at how little an impact the rapid hiking cycle has had. Whereas in Europe has been a bit more exposed to the costs of higher interest rates, because in some countries people do have floating rate mortgages, and small businesses that don't have access to the bond market and depend on bank lending are also facing higher borrowing costs.
Yeah, for sure. We have 8 minutes left, and still a couple of things to discuss. Just briefly, and I don't know if both of you or just Ben wants to get into that. The longer term risk of sovereign debt across the EU, and also maybe a little bit the situation in the US and emerging markets.
Yeah, I mean, just to say that, fiscal policy is becoming an increasingly interesting topic. In the EU, you are seeing fiscal consolidation now. In the United States, you are not. Annual deficits in the United States look set to continue, 6-7% of GDP at least for the foreseeable future. But in Europe, you are seeing some significant consolidation, and one of the reasons is because, the key reason, there's two main reasons, I suppose. One is that all of the pandemic era programs that supported incomes and provided other support, those have now all ended, and that's one of the reasons why there was some fiscal consolidation in 23. You're also seeing that there were some special energy subsidies that were phased in. Some of these still exist, but they've proven to be less expensive this year than many people were expecting because energy prices have come down. So it's been less costly to provide these subsidies. Most energy subsidies, we think, are going to be phased out over the next couple of years. Another thing that's happening is that the EU suspended its fiscal rules during the pandemic, and this lasted through fiscal year 23, but in 24, the fiscal rules are going to come back into effect. And so this is the Maastricht criteria of you're supposed to keep budget deficits below 3% a year, and you're supposed to keep your debt to GDP level below 60. That one is going to prove a little bit trickier for many countries, which is why the Commission has proposed certain reforms to the fiscal rules that will not halt the consolidation in any way, but will make them a bit more, will make the plans to achieve fiscal consolidation a bit more bespoke, let's say. The Commission wants to negotiate individual deals with countries that don't meet the criteria, and we haven't actually come to an agreement yet on how the fiscal rules will be reformed, but if the Commission's proposals are accepted, we would get rid of the rule that says you have to make 1/20th commit to reducing the fiscal deficit, the debt to GDP ratio by 1/20th every year, and we'll come up with a debt sustainability analysis that will be agreed by the member state government, which getting the member state to buy in and commit to this path is critically important to making these plans succeed. So we'll see. But in the United States, it doesn't look like there's going to be any fiscal consolidation in the short term. And that's one of the reasons why people are a little bit worried about what that means for longer term interest rates in the United States. And that's also one of the reasons why people are a little bit worried about emerging market sovereign debt, because typically high US rates and a strong dollar make it a little bit more difficult for emerging markets that have borrowed in hard currency to service their debts. But I've talked too much about this, so let me stop and see if you guys want to weigh in.
Madalena, any final comments? Any takeaways?
Final comments, I would say we should also always keep in mind long-term issues. And we've talked a bit about comparing the performances so far. And if you ask me about looking forward, I know you've had some conversations about this, but maintaining a certain level of attention on EU competitiveness is very important. And maybe this is not something that has reached the debate in the US, but the EU is really starting to focus again on this. And I think in going forward, these are just very early policy initiatives. So you've seen Mario Draghi being tasked by President von der Leyen with a report on competitiveness. There's new attention being given to the importance of the single market, which of course was something that people had a bit put to the side during the emergency of the pandemic and, you know, allowing national state aid. But we're now going back to what we perhaps need to do to strengthen the single market. I think these are going to be very important for the long-term conversation. And even though it's very early days, it shows again that the EU is not standing still, and it does also recognize some of the weaknesses that may have been highlighted, you know, in the difference of growth performance with the US. So it's got a to-do list, but it's starting on it.
No, it's good. And yeah, absolutely. I mean, the EU has been doing amazingly in terms of, you know, reforms that are really, I mean, I don't know if it was the pandemic that triggered that, but I think the effectiveness of EU reforms is at an all-time high. No? Wouldn't you agree? Is it just me? I mean, I obviously drank the Kool-Aid. If you look at my job, and
if you look at, I mean, historically, just number of policy initiatives. Yes, of course, we've done more since the start of the pandemic than probably in the past 15 years. So yeah.
Ben, final last words.
Yeah, I mean, look, I think that this has been a challenging year for Europe, but I think the key adjective really for both sides of the Atlantic is resilience, right? The United States has done better than expected, and it's very impressive how resilient the economy here has been in the face of various headwinds. But the headwinds in Europe have been much stronger, and have had, you know, taken much more of a chop out of you know, the European economic capacity. And so the fact that Europe has done as well as it has, I think, is also quite impressive. And now we're sort of converging towards a soft landing, as we titled this discussion. And growth rates in Europe and the United States should be relatively similar in 24 and 25. And hopefully we're going to, you know, if the forecast is right, we're going to avoid a recession on both sides and get through this period of getting inflation back to target, and then we'll see where we are, and we can make the investments that we need to do to keep our economies competitive and make sure that the green transition works, and we can deal with the effects of climate change and further geopolitical instability and make sure everything keeps working.
Yeah, and we do that together. That's the key part, in my view. No, I mean, nobody wants to do this alone. And especially EU and US are the perfect partners. But here I am again, preaching. Sorry about that. But thank you so much. Really great discussion. As always, love having you guys. And thank you for sharing your insight with us on the economic outlook that was just published. We will publish on the executive summary of the outlook on the website in the next hour or so, with a link to the entire analysis. I read it the last couple of evenings. Very interesting information in there. And to our audience, a quick reminder, if you are a member of the EACC and you would like to connect with any of the other participants, we're happy to facilitate that. We have, as I already indicated, a couple of really interesting seminars coming up. November 12th, the EU Mobility Directive. December 1, together with our friends at the Irish Consulate, a working lunch with the president of the Eurogroup. We have a discussion about the digital euro and other central bank issue, digital currencies, on December 7. And December 12, risks stemming from the intertwined financial markets should also be a really good discussion. We will upload a recording of the seminar on the website. And with that, have a wonderful Friday. And if we don't talk before, happy Thanksgiving for our friends on this side of the pond.
Yeah, happy Thanksgiving to everybody. Enjoy.
Thank you, everyone.
Thank you.
Ciao, ciao.